Good day, everyone. This is Joseph Trevisani from Worldwide Markets. I thank you all for attending. As always, I am flattered by the fact that people take time out of their day to listen to what I have to say. Today we're going to keep, or attempt to keep, to a relatively strict currency topic. That would be the euro, the world's favorite trading currency against the dollar. More volume goes through the euro than anything else. A few notes. As always, if anyone has any comments, questions, or my usually requested jokes, please type them in, and I'll certainly stop to see what we have to say, and maybe we can get some input from the audience as well. If you have any questions, type them in as well, and we will talk about them. As you know, I prefer to conduct these as a give and take, as a colloquium, rather than as a lecture. With that, let us begin. What you're looking at is a 25-year chart. No, I actually cut off the dates. That was foolish. Is a 20-year chart of the euro. And she'll ask, how do we get a 20-year chart? Well, that's pretty easy. Before 1999, I put this one up in a hurry, as I'm sorry about that. I cut the dates off. Before 1999, the components of the euro were fixed at a percentage rate when they started trading in 1999, stemming from the Maastricht Treaty and before. So they just projected the actual rates of those historical rates of those components of the euro back into time. So we can see where we are. It's been a pretty dramatic history we've had here in the euro. We had the euro started, if I remember, about 1.2 to the dollar in the euro trading side, so above the dollar, above parity. Fell down well below parity, up to a low of about 0.86. This is actual trading. And then it's been climbing or being stable ever since, except for this last collapse. Now, if you look at this, you can see that this collapse here, from last May till now, is, except for the fall of the euro, which was actually not a fall of the euro, but a reigning ascent of the dollar during the financial crisis of 2008 and 2009. This is the most pronounced, the deepest, and the fastest fall in the euro and rise in the dollar. But this one is actually a fall in the euro since the euro was created. There are larger questions that are taken up by this, of course. Currency movements, in most cases, I would say almost all cases, except perhaps this one, do not predict, are not comments on, the imminent collapse of the currency, or the imminent, if not dissolution, of fundamental change in the currency. Because of its nature, because it's a created currency, because it has in the middle of it to weather its first crisis. This is the euro's first, I will say. If we're looking, as I am, to predict the future, that's what we all do. We're all little Merlins here with our crystal balls that collapsed in 2008, stemmed from an immediate, almost instantaneous appreciation by the market of how erroneous their prior assumptions about the euro had been. Now, just to set the background here a little bit, this was the subprime, which was originally known as the subprime crisis in the United States before it became the worldwide financial crisis, recession, and everything that's followed since then. Originally, both on the continent and here, I noticed that the former Fed chairman, Ben Bernanke, now is out in public again. I guess he took a little hiatus. Maybe he went to Cancun or someplace. I don't actually know. And he has a new blog out on the Brookings Institute, which is a sort of a middle-of-the-road, mildly democratic, not really, think tank in Washington. And he's saying the Fed needs to raise rates and a lot of other things. I've not yet read his blog this morning. I'm doubtful it will become a staple, but I will certainly read it on occasion when there are things of note in there. I don't know if he plans to publish daily or not, as many of us have to. At any rate, during this period, the run-up to the financial crisis, when the euro is ascending here, and this part in the summer, early summer of 2008, the considered opinion of the central bankers, remember, the people who for the last 6 years have been running the world with all of their monetary policy, with all of their QE, on and on and on. In the period right here, and I bring this up because it not to castigate central bankers, who I'm sure are doing their best and are good people, but to note that the assumptions and the analysis of the premier monetary institutions on our little planet that circles around the sun with a big moon overhead have not been terribly accurate nor prescient. In the period here, the two major central banks of the world, forgive me on the two Asian central banks, which are certainly very important, but less so, the Europeans and the Americans. Where are the Europeans saying? Well, Jean-Claude Trichet famously was saying, well, we have no problems here. Sort of like, what me worry. And Ben Bernanke and the Fed were saying that the subprime crisis is contained. Well, clearly it wasn't. And clearly the analysis of both. So those were the basic assumptions that helped fuel this euro rise, or at least permitted because at this period, I'll show you the chart here. Where's my Fed funds thing? Okay, the Fed funds right here. You can see back then, over here, this is the period we're talking about right here. The Fed was cutting rates. Although, even though they said there was no problem, the Fed was, sorry about that. The Fed was cutting rates dramatically. I should have imposed that. Through this period right here, the Fed is cutting rates. So, one of the reasons the euro is driving up is because the Fed is cutting rates. Even though the Fed is saying at the same time the problem's contained, we have no problems, what me worry. And Trichet was saying, hey, this is not going to affect us. We got no problems here. Well, neither one of them turned out to be very accurate. This, of course, collapse was, and I'm sure you all remember, I know I've spoken about it before because it is one of the chief points that we have to remember, I think, when we take it into our mind to treat the utterances, the projections, the wishes, if you will, of the central bankers as gospel, as the best that there is. They are not. They are subject to enormous amounts of institutional bias and policy bias. But again, this is not a session solely devoted to the central bankers, but unfortunately in our monetary world, in our trading world, that is all that matters now. Not completely, but very much. It is the policies of the central bank for the last 6 years that have been driving everything we've seen. And that's going to continue to be true. So let's go back to this just as an example. Forgive me if you've heard this before. I know some of you probably have. Summer 2000, July, I believe, 2000, I don't have the ECB up here, but the July, I believe, 2008, what does the ECB do? They raise rates. They raised rates. Probably the most inappropriate rate increase in the history of central banking ever. I mean, going back to Nebuchadnezzar and God knows who else. They raise rates. Cool, 25%. I mean, 0.25%. Wow, things are really hot in Europe. They don't have to worry about any of this stuff. It has always puzzled me how this was possible. How could the head of a vast bureaucracy in Europe not know that the European banks were stuffed full of all this stuff that had been sold by Wall Street? Be that as it may, Mr. Trichet raised rates. And not maybe a month later, 2 months later, I forget the exact timing, he had to come back and say, whoops. And he didn't actually cut rates, but what he said was, things might not go as well as we think they are. And that's all that it took, because that one comment made everybody realize that the assumptions that the market had been operating under, the rate assumptions, the economic assumptions, the blasé, if you will, assurances out of central bankers. One thing we must remember, central bankers are not simply analytical gnomes sitting there running their equations, running their theorems, coming to conclusions. They are public figures. They are public figures with vast impact on the markets, which we all know. Everyone attends on Janet Yellen's utterances as if it is the oracle, or at least some lower level of oracle. So that one thing, that one comment by Mr. Trichet undermined the entire set of assumptions, and this is what we got. Okay, so is there anything analogous here to this fall that we are seeing? I don't think there is, except in its effect. This was a market backhanded. Suddenly, does anybody still, I'll comment on that. Does anybody still watch Looney Tunes? I know I talk about my kids a lot. I have two girls who are 6.5, and they have never actually seen Looney Tunes. And I'm afraid that, that when they see them, because some of those old cartoons, those Hanna-Barbera and Looney Tunes, are incredibly violent. I mean, it's cartoon violence, but it's incredibly violent. Anyway, sorry about that. Yeah, we might be. I take my girls to school every morning, so that that's how I start my day. Anyway, so the situation here was produced not by a changing of assumptions, whereas something was undermined, but by very, very evident transparency on both parts. It was actually produced by an assessment, a changing assessment of what the world economy is up to. Now, historically, I'm talking about actually the United States and Europe, or the EMU. Historically, the United States performs better than Europe. That means it grows faster. There's less of a social net, but its economy is more flexible. It's also easier simply because it's one nation speaking the same language, although people might disagree on that. And labor movement is much simpler than it is in Europe. It's much more complicated in Europe. Europe is attempting to create a federal nation when they don't have federal states, be that as it may. So it was never, and it had been my assertion in most of this ascendant period here for the euro, that the dollar will return, for the simple reason that and no matter how long it takes, central banks move away from their emergency policies, and it's taken much longer than I think anyone, including the central bankers, expected. The traditional sort of split and dominance of the U.S. economy, dominance in terms of growth rates, will come to the fore, as it always has in the past. And this is what we've seen. Now, you can make the case, and many supporters of Bernanke and the central bank supporters, people who agree with his analysis, will say that it was because of quantitative easing. I don't agree with that. Nevertheless, since the two are coincident, as we all know the famous line, coincidence is not causation, nevertheless, Mr. Bernanke and others will make the causation argument for the quantitative easing policies. They largely make it in the negative by saying things would have been worse, and they can't really prove it. Nevertheless, that's the argument that's made. And it's a tough one to dispute, simply because there is the proof of the U.S. economy performing better throughout this period than Europe. Up until around here, it looked very much like Europe was going to do reasonably well also, despite some of the Greek perturbations which caused this collapse here. Now, much of the effort of the central bankers at this time was to keep rates in the U.S. as low as possible. The Europeans resisted this roundly. They have since sort of surrendered, more than sort of, they've sort of surrendered. So this move here is based on the market's policy assumptions that the Europeans were actually going to do this. And what, meaning quantitative easing. And what prompted this display on the market's part of confidence that even though they have spent years resisting it, primarily from the Germans and some of the northern European countries whose economies remain in very good condition. I was talking to a friend of mine who runs a restaurant here in Manhattan, and where I live, and he was telling me that his son, who had just graduated from college, has gone off to Germany. One, he's following his girlfriend, but two, he's now working there. The German unemployment rate is somewhere like 3.5%. I forget exactly what it is. Now, he has dual American and Italian citizenship, so that he can work anywhere in the EU. No trouble whatsoever finding a job in his field, even though he doesn't speak German. So that gives you some sense, very minor, of the worldwide strength of the German economy. I know I've spoken about Germany many times. It is a necessary fact of dealing with Europe and the world economy. I talk about the United States all the time, too. I speak China less so, but China is also a fascinating case. But the German economy is a one-of, complete, not entirely, but very much 75%. It produces products that, for whatever reason, and I'm not going to go on to my favorite cultural topics, are in demand around the world, day in, day out, recession, expansion, and moderation. And that is something that not many economies can say to the same degree that Germany can. Mercedes and BMWs and Audis, just as an example, and there are many industrial products that you really don't hear about in the general media, remain in demand everywhere. Seems like the first time you get a middle class, or they start going out and first thing they do is start going out and buying German cars. Okay, so this difficulty here came from the, hold on, let me just check here. There's something, okay, that's fine, thank you. Oh, I just remembered, sorry, I forgot to answer someone's email. I will not mention who it is on air, but I've neglected to answer someone's email, and I will take care of it as soon as I get off the air. Anyway, so what happened here, which drove this, is that the European economies, despite what had gone on before, where they were having some reasonable growth, reasonable employment, got worse and worse and worse. They were getting so bad, and more than that, they were getting deflationary. Now, the strange thing about what the central bankers have done, and this is something the United States is talking about as well. Let me bring up this chart here to show you what it is that I'm talking about. Where is it? U.S. Okay. Not that one. Okay. This is year-on-year deflation. It is deflation, but not really. Inflation in the United States. I didn't bring up the one from the EU, but the EU one is just the same. This is the one that the Fed looks at. This is core PCE. This is the latest release. I believe it was this morning. 1.4% year on year, had been 1.3. All around the world, the Japanese, the four largest economic blocs, the Japanese, the Chinese, the Americans, and the Europeans, have been flooding the world, and this didn't just start last month or 2 months ago. The Fed's been doing it for 4 years, have been flooding the world with liquidity. It's supposed to create inflation. And oddly enough, what has happened? It seems, remember, correlation is not causation. All of this amazing liquidity been pumped out there into the world seems to have created disinflation, deflation. How is this possible? It doesn't seem logical. It doesn't seem to fit monetarist theory. Yet we are looking at the result of, after 5 years of quantitative easing. Let's just look at this chart here. And it's going to go right back to the euro and why we are there in the euro. Let's look at this chart here. This is the United States, the Fed's favorite, personal consumption, expenditure, price change, I think they call it. Anyway, core PCE index. So the Fed started quantitative easing back here in 2010. And what happened? We now have deflation, or close to it, in the United States. And the puzzle as to why this happens, and I don't think I've never really come across any analysis of it, and I think most theorists and most economists would dismiss the two. They would say correlation is not causation. The two are simply not connected. I have my doubts. And let me tell you some of the logic that I use for this. One of the things which, I'll put it more simply, inflation is a product of two sides. It's a product, of course, of supply and demand. Supply and demand for goods, supply and demand of money. If there is no or slow demand, then prices cannot rise because firms cannot increase their prices because they will lose sales. On the other side, we are measuring the price of goods and services. Let's just stay to the goods side. If you're on the goods side, one of the things that has been going on in the world, and this is generational, I would say, or at least 20 years, and is not strictly due to the policies of the central bankers since the financial crash. Everyone, and I know I've spoken about this before, but since it plays into this as well, I will bring it up again. Many of the themes that I deal with in each of these webinars are the same. The underlying themes, they get expressed differently depending on the topic. In this one specifically, we're talking about the rate of the euro against the dollar. But the drivers underneath are the same drivers that would be driving European economic growth. There has been an enormous and ongoing increase in the world's productive capacity. China, and many other countries as well, not just China, have become industrial powerhouses. And what do? Well, they sell goods around the world. The price difference between goods produced, just as example, I'm not picking on China, in China, and goods produced in the United States does what? Or goods produced in Europe? It drives down prices. So there is a worldwide deflationary trend, impetus, disinflationary trend coming from all of this productive capacity. What is one of the things, certainly in China, but other places as well, that is fueling this massive rise in productive capacity? And that is all the stimulus that's been going on around the world, particularly in China. That stimulus, in China it's a form of lending, not exactly the way we do it here. Nevertheless, it builds things, plants, factories, houses. And for the ones that produce, there is a disinflationary pressure generated by their products. And that's true as of wages as well. One of the things, the Fed and others have spoken at times about wages. And if you look at, it's interesting. The many statistics that are out there in the United States, I didn't have time to put together all of them that I wanted to, but we have some examples. This is non-farm payrolls. Everyone who is a bull on the U.S. economy cites non-farm payrolls. Okay, that's perfectly okay. Now, you look at that job creation chart and that trend line, and that's a good trend line. That's a good trend line not just now. It's a good trend line going back 20, 25 years or more. The problem is it's about the only U.S. statistic that is showing this type of buoyancy. Most other statistics in the United States are either disappointing, meaning that they have come in under, and I have a few of them here. Let me see if I find them here. Where are all these? U.S. macro compare. Okay, this one. Now, I think you saw this before. I didn't update this chart because most of these things are still not here. It was only a week ago that I did this webinar. These are various U.S. statistics. And you can see this period here is showing a decline in most of them. You can do the same thing with the Fed surveys. You can do the same thing with industrial production. You can do it with factory orders, with durable goods orders. We are seeing a pattern that we have seen for quite a few years now, both in optimism on the part of the analysts, early season performance, and then failure. Or put it a different way, hope in the latter part of the prior year, which does not deliver in the new year. And we're seeing that again. So this particular chart here is one that everybody quotes. Okay, that's very nice. So back to inflation. Remember, the two things that the Fed is talking about, which is going to go right into our analysis of the euro, are inflation and jobs. The other worldwide economic effect of development everywhere and the disparities in earnings is, of course, the obvious one that lower wage countries that export put pressure on wages in higher wage countries, especially in ones that have as open an economy as the United States. We've certainly seen that as well. So part of the development process in the world has been both to raise living standards, rates. Yeah, Bloomberg is great. Can't argue with that, and it is expensive. You're quite right. But there's no information system out there that's even comparable that I've used to Bloomberg. It is pretty expensive, though. It's a business thing, really. You can do great stuff with it, though. Ex-mayor of my hometown, New York. Anyway, so the pressure on the worldwide economy is not only to raise up. It's a leveling process, of course. It's not only to raise up those whose economies were not as productive, were not as wealthy, but it also has a tendency to depress wealthier countries. And even though I cited Germany earlier, this is true in Germany as well. Germany did a number of reforms on its economy about 10 years ago. They were in advance of this. There were pressures on the unions not to pressure so much for wages, and that took place as well. So Germany as well, despite its position as, in my opinion, the world's economic export leader, although the values of Chinese exports in total are now a little bit more than those of Germany. Germany has 80 million people, and China has 1.2 billion, I think. So anyway, that gives you an idea. Okay, so the two factors in the United States that are being cited for the improving attitude of the U.S. towards its rate increases were inflation and jobs. Now, we all know this, so I'm not going to bring it up ad infinitum. Okay, so what we're seeing here, and this is what's driven, because this goes to our next question. This fall here, this great 25% move in the euro, I hope everyone participated in it and made lots of trading profits, was predicated on the change, not just in Mr. Draghi's announcements, but in actual fundamental change view of the European economy. This is a very fundamental tradable move. Now, the thing that you're betting against, if you're betting on the euro going down, of course, is that suddenly the European economy is going to turn around and start growing like gangbusters, and then the euro's going to have to start raising rates. Okay, well, that's a bet I would take. That's a bet I did take, and I'm sure you did as well. So the analysis at this part here is a fundamental trend. So we have this really large move. Sorry. When you have kids, you tend to have a lot of nagging little coughs and things in the family. Anyway, I'm sure you all know that. So this move is based on a fundamental change in what people are predicting about the European economy and the U.S. economy. And those fundamental factors played out. Mario Draghi did what he did. We've got to start raising. He finally got it through. We can start quantitative easing. The Fed finally, despite all of their hemming and hawing, ended quantitative easing, and now they're talking about raising rates. Those two changes, front ran by the currency markets, are what gave us this move. The question we have now, over here, let's take a look at a much shorter euro chart. Where's my shorter euro chart? There we go. Okay, this is the year euro chart, and these are the trends. Okay, just to show you that. This, and then this accelerated here. Okay, there was actually a break right here that day right here. I forget what day that is. Okay, and then we have this move right here. We're still clearly in the down channel for the euro. This move right there, if you take a look, I actually have that chart. Okay, this is that final move right there. When I came in, when I made this chart, euro was sitting right on the bottom of that trend line. Okay. A couple of minutes later, when I came in, euro had gone through. I don't know where it is now because I'm sitting in a room, not at my desk, and I don't actually. I could pull up the chart here, but I'd rather not. I believe when I came in, it was about 20 points lower than that. So not a big move, but it had cracked that particular trend line, which is moderately important trend line. But anyway. So the question that we have is this. Aside from the technical point of view, let me get my euro back again. Let's do this one. This is a better one. Is this bounce signifying a change in the fundamental appreciation? The fundamental situation between the euro and the dollar, between the European Monetary Union economy, its policies, and the Fed. Because if we look at the historical factors, we can see that although this has been a big move, there's plenty of room to go. We're at 08, another 20 big figures, not quite, for the euro to go down just in historical terms. And considering the possibilities, there's no way that couldn't happen if certain criteria or certain things happen in the world economy or in the European economy. So there's nothing prohibitive from a fundamental point of view that the euro has reached some sort of limit and it can't go any further. So we can set that aside. So the change in the European appreciation of the European situation, and this is largely, I think, aside from Greece. Greece is a fun wild card, and I don't mean that in any sense to in any facetious sense. From a trading point of view, Greece is a wild card. And it's a fascinating story, but we're not going to deal with that here. We've actually dealt with that before several times. So from a fundamental point of view, aside from Greece, and Greece is not a factor largely in this collapse in the euro. It is a bit, but not very much, because through that that's possible. One of the things I think that's happening throughout this period and even today is that the markets, having gone through this, we all forget, but This crisis in the European debt system is now like 5 years. It's 4 years old. 10, 11, 12, 13. It's almost it's 5 years old, because it started in the beginning of 2010, actually the fall of 2009, late part of 2009, when the Greeks under Papandreou, I think so, said no, our deficit's not what it was, and it's all come from there. Everything has started from there. So time flies, and this certainly has. And originally there was much more speculation, rife speculation, that the euro would fall apart, or at least Greece would leave. That's calmed down. It's really not the case. And the intensity of the speculation now on Greece leaving is surprisingly much less, when I think the chances now are much greater that they might. But through the period that we're looking at here from last May until now, the assumption of the markets has not been that there will be a Greek departure from the euro, but that the Europeans will figure it out, they'll muddle through. And that is still essentially the position of the markets. So I think whatever we lay, and we have spoken about it already, this decline in the euro to, it is not to problems in Greece, which remains a wild card. So the fundamental change here has been the divergence becoming very obvious and very supported by the two central banks based on their economies, where they're headed. Once the markets get a hold of the idea, based in economic performance, that the two central banks are, one's going to be lowering rates and one's going to be raising rates, there's only one way to go. And that's why, and that's a very unusual situation. It's as unusual as the flight to quality for the U.S. dollar in the period of 2008 and 2009. It is rare, certainly, that major central banks end up going in different directions at the same time. And the reason for that is the world economy is very linked. Okay, now let's step back a second. So this fall change in the euro and the dollar was based on largely on economic assumptions transmuted through the central banks. The pause at the bottom here, now let's do the other chart. Let's do this one right here. Yeah, this one right here. This pause right here, in my mind, is a very logical, I'm surprised it took so long, profit-taking move. Do you remember that this day right here? We ended up with, it went up on stops at about 4 o'clock in the afternoon. The euro went up from 108.50 to 110.50, and within 45 minutes it was back at 108.50. That is the most classic stop-loss run I've seen in many years. As soon as the pressure is off, it reverts to its starting point, and that's exactly what we saw there. So all of that is profit-taking. There's no indication that there's any reversal in trend, and I would still say that here, that there is no reversal in trend here. Okay, so let us go back to the causes of this and see if anything has changed. Yes, that's right. I'm going to talk about the problems. I'm going to talk about that in a minute. As far as what the Fed is doing. But the fundamental factors that we have here have not changed. We have a few glimmers of, one or two figures out of Europe that seem to indicate that are a little better. A trifle better. Everyone, of course, is looking. Everyone who wants the euro to go back up, or not wants it to go back up, but is looking for analysis, will look at those and say, okay, here we go. The one thing that we have to remember is that everybody out there, we all know this, they tend to talk their book, and they're long the euro, and they want the euro to go up. Okay, we know that. There's as yet no indication from European statistics that quantitative easing is going to start working, that you have anything more than month-to-month, week-to-week, day-to-day variation in economic statistics. It may happen, but we haven't seen it so far. Anyone who's front-running an improvement in European statistics is placing a bet, but they don't really have any statistical support for it. Yes, there are analysts that are saying 110 to 115. I agree with you. The older attempts or the older analysis was along the lines of Goldman's of a month ago that we're heading to parity. In my mind right now, either one is possible, although I still lend towards the lower value in the euro. Okay, so we have no potential change indicated so far, or very minimal, in the European statistics. On the other hand, on the American statistics, we actually have some concern because if strength in the U.S. is one of the things that is driving the Fed and its abilities to raise rates, then, or its willingness to raise rates, or its desire to raise rates, then we've actually have seen in the U.S. a diminution of many of the statistics. Not so far non-farm payrolls. Everyone who wants to cite the bull case for the U.S. economy cites non-farm payrolls. If you do an analysis of non-farm payrolls, you'll see that many, and this is one of the issues with wages, that the type of jobs that are created tend to be lower paying, sometimes part-time jobs that simply do not add a tremendous amount of purchasing power to the U.S. economy. And that's one reason wages are essentially stagnant and have been for 5 years now. Okay. So on the European side, there's really no indication that we're getting a recovery, although we may. It is my opinion that quantitative easing is not a producer of economic activity. It tends to put a floor under things, but it does not promote growth. And the reason it doesn't promote growth is because it distorts one of the main ingredients for business in creating new jobs. That's a cost of funding. When you distort that, you can no longer trust the price of one of your inputs. And it's very difficult to make long-term plans when that's the case. Okay, let me take a look at this. No, I don't think the euro rates are going to raise, and I'm going to talk about the rise, and I'm going to talk about the U.S. in a second. I mean, what Mario Draghi has said is that we're going to keep doing this. I think the original time was for a year and a half, and their purpose is the same as the U.S. was. At the zero bound, you can't reduce rates anymore because there's no place to go. So in an attempt to drive down market rates, the central banks go actively into the markets and buy up securities, bonds, and when you buy up bonds, you send the rates down. So that's what the ECB is trying to do. And they said they're going to do that for the next year. And if you look at European sovereign rates, except for Greece, that's all happened. Now, I don't know. I'm assuming that European commercial rates have followed somewhat, probably not as much as they want. So that's what the Europeans are doing. Let me talk about these. So they're going to keep doing that for a year and a half. So the pressure on European rates, or at least the preventative on European rates from rising, should be there. In the U.S., the Fed clearly wants to raise rates. They talk about it all the time. They've been talking about it for a year. Janet Yellen's been talking about it for more than a year. Actually, about a year. As Fed chair. So the issues that the Fed is having, and this is another possible reason for the bounce that we've seen, in addition to the natural profit-taking motive after such an incredible run, the Fed is getting a little antsy, I think, about raising rates. They're clearly aware of the distortions that are created by this zero rate policy. Anyone thinks that the market is not to some large percentage point, and I can't put any figures on it, fueled by this type of monetary creation, I think is erroneous. I think it is. You can make a case, if you want, for the collapse in oil prices, having to do with this as well, in that as the prices were high for a long time, over $100. And frankly, from an economic point of view, I will say that the oil price at $100 didn't make a whole lot of sense. There, at least if you're talking supply and demand. But one of the things that happened is that high price, which to some degree is that's exactly right, made fracking possible because fracking is a much higher cost way to produce oil. But when you have prices and you have the technology, and you have prices at $100 a barrel, $90 a barrel, all that fracking is profitable. One of the reasons the oil price is up there is because the markets are driving prices higher. Well, why are markets driving prices higher? There's a huge amount of speculative trading in the oil markets. And some of that money is simply driven by liquidity-made search for profits. The scramble for yield goes to the trading markets as well. So you can make a case. I don't know how you would quantify it. You could certainly make a logical case that if part of the driver for high oil prices is the search for yield in trading markets, then the economic effect is a misplaced investment in the oil patch, which as it starts to produce and as the world economy starts to slow, drive prices and creates all this disinflationary pressure. Okay, so on the fundamental side of the move that started here, I want to make sure that we get to the end of this. Of the two factors here, the euro factor, I believe, is not going to change. In that the European economies, I at least don't see any real positive movement there. And the ECB has already contracted to be reducing rates for a year and a half. I don't think it's going to produce much growth, but it is going to produce lower rates. The one thing the central banks can do when they do QE is get rates down simply because they're out there in the markets buying securities, buying bonds. Well, if you're buying bonds, they go up, your rates go down. The Fed proved that this works. They haven't proven that it generates economic growth to any great degree, but it does work to drive down rates. So the European rate side, I think, is going to stay the same. The question now, let's deal with it, is the American side. U.S. economy does seem to be hitting a slower patch, as they might say. Reasons are difficult to assess. Logically, it does not seem to me that just as with Trichet back here saying, what us worry, we have no problems, it does not seem to me that the U.S. is going to be able, and it's certainly been proven over the past 5 years, every time there's an anticipatory breakout, it never happens. The U.S. has been growing 2.3%, 2.4% a year since the recession. Very little. First quarter growth is going to be grim. People are going to blame it on the weather. It's not the weather. Partially it's the weather, but mostly it's not, just like it wasn't last year. So the idea that the U.S. can continue to grow in the face of China, which is not talking about stimulus yet again. Well, what do they do when they stimulate in China? They build more houses. They build more factories. Factories need to produce more of the same. Europe. Very little, in my mind, expected growth. Japan. Latest figures. Not quite grim, but dismal. There isn't a lot of growth around the world. Emerging markets slammed by the dollar. So even though the U.S. is performing better, the idea that we're going to get the type of robust growth is not happening, to my mind. So back to the Fed now. The other ingredient in this fall, the fundamental factor, has been the anticipation that the Fed is going to start raising rates. Well, the Fed has been at pains to let us know that yes, they want to raise rates, but not really. What the Fed really wants, and this was said by someone from BlackRock, they want an immaculate rate hike. Forgive me, but what he meant was that they can hike rates and the Fed funds and have no economic effect. This is not going to happen. But I think they're terrified of it. They are at pains to say that, yes, they still want to raise rates, and they're not going to do it. It seems like they're not going to do it in June. It's being put further off. But we're not going to raise rates very much. It's going to be a long time before rates rise. Why is that the case? That's not the standard Fed policy. Here's Fed funds. Okay, this is a Fed funds. This is historical on Fed funds. That's nothing about this thing is normal. Once you get past here, this is the standard Fed policy. Look at this. Oh, again and again and again. That's the Fed policy. They're at pains now to tell us this is not the Fed policy. This is a 30-year, 40-year chart on the. Nobody, I think, knows if you project this Fed the 10 years. Oh, this is the Fed funds. If you project this down here, the Fed funds should be somewhere around 3%. Does anyone think the Fed funds are going to 3% anytime soon? No. So the Fed, which is the other side of this chart, is now saying that we're not so sure about what we're going to do. The question is, now let me ask you this question here. Oil price. Oil price is affected by by obviously supply and demand, and by what the dollar does. So the three factors all played in on the same side in that great fall in oil prices from 100 down to 43. Dollar is getting stronger. The U.S. was ascendant in oil production, and oil demand was stagnant or falling. In addition, there was the factor, which doesn't get much play, that the market was so high because of trading chasing of yield, looking to make money. No way, in my mind, there's no way oil should have been at $100 or $105 with the supply and demand factors that were out there in the world at the time that anybody could have paid attention to. Everybody was aware of the fracking for several years now in the United States and how much oil it was producing. So the oil price, I think, is hit the same type of, there's that as well, excuse me, has hit the same type of factor that the euro and the dollar has. Meaning, the adjustment based on fundamental factors, I think, has reached its limit with the current factors. The question for the U.S., and this will determine this along with Greece, but Greece is a wild card, so it's very difficult to predict. So I will wrap up. Here we go. When we're looking at the dollar and the euro going forward, the European side, I think, is not going to change very much. The change factor plays in through the United States. Now, not yet has it reached enough of an alteration in U.S. economy and then reflected in Fed policy to change the market assumption. The assumption that the U.S. is going into raising rates. Because if the U.S. raises rates 1 point in 0.25% in, say, September, and they don't raise again for another year because the U.S. or 2 years, because the U.S. economy, as I think it probably will be rather dramatically affected by the ongoing slowdown around the world. There is a lot of stuff from the financial crisis and the building of various economies in the past generation that has simply not, that has changed the complexion of the world economy, and it is not factored in to analysis, not factored into currency trading, to various markets. So I think what we're going to see for the next 3 to 4 months, until we have, unless of course Greece leaves the euro, and then the euro goes back down hard, because there's an enormous amount of debt in the European Union that is tied to this and is all going to be a mess. The factor to watch in the U.S., as it's been for 6 years, has been actually for 2 years in this case, has been the Fed's, the balance between the Fed's desperate desire to raise rates. And I think that's what it is, because they realize the amount of damage that these low rates are doing and distorting the economy, against the dangers of raising rates. And I think that we are going to get the Fed attempting to play both sides. And if they do that successfully, then the market will not change its assumptions about the Fed and rate increases. But if it is unsuccessful, or if the U.S. economy performs even worse than it is now, and especially if you start to see a decline in job creation, then the strange view, maybe not strange view, will be that the euro will benefit from that. And I think that is a distinct possibility, though I am not giving it the preponderant odds right now. It is a definite possibility. And in that case, you will see the euro rise. I think at any rate, the market's not going to do anything for about, we're in April, at least until the June meeting. After that, and especially if in the interim U.S. statistics get worse, that will change the assumption of the Fed raising rates. That will change the euro and the dollar, and that will generally support the euro. So that's it, folks. That is my analysis on this. I hope this has been of some use. I thank you all for attending. I thank FX Street, Adinda, and Maud and Vicky for putting these on. And I'll put my email address up there. If anyone has any questions, comments, or jokes they'd like me to use next time in my desperate search for jokes, please send me an email, and I will be glad to answer. And for those of you who have written me emails in the past, and I know I missed one, I will attend to this as soon as I get off the air today. Thank you very much. Take care.